Hey guys, it's Robert Weinberg, and on this channel, we empower people to take control of their futures through expert mortgage, financial, and real estate strategies. If it's your first time watching, go ahead and hit that subscribe button. Also smash the bell so you get notified on all of our future content. Now, in today's lesson, we're going to talk about DSCR loans, or debt service coverage ratio loans. These are a super hot loan product really in the last 12 to 18 months, and they just keep getting more and more exposure as people find out what these loans are all about. These loans are generally going to be used by either first-time or seasoned real estate investors that are trying to expand their portfolio. So what it is a loan that does not require you to show tax returns, employment verification, pay stubs, or all the other documentation that you would need for either a conventional mortgage or a government-backed loan. That's not required for DSCR. So how does it work? How it works is, as part of the mortgage process, we're going to get an appraisal on the property, and generally the investor that's underwriting the mortgage is going to use the rental income that it shows in the appraisal report on the operating income statement to qualify your loan. Generally, if the new mortgage payment with tax insurance is less than the rental income, the deal qualifies. That's just a general blanket statement. Some DSCR loans have different ratios that you need to stick to, but generally, if the rental income is going to exceed the property mortgage interest, the principal, interest, tax, and insurance, then you are in good shape to move forward with a DSCR loan. Now, the credit score requirements on these are very different from other types of loans. So you're not getting a DSCR loan if you have a credit score in the 500s or the low 600s. The lowest that I've seen the credit scores on these go is usually around the mid 600s. 640 to 660 is really a starting point. Generally, 680 or above is preferred to get decent terms on the loan, okay? So if you have lower credit, you're going to want to work on that first before actually moving forward with an application for a DSCR loan. Now, LTV, which stands for loan to value, that's the amount that the mortgage company is going to give you versus the price of the property or the appraised value of the property, whichever one's lower. So the loan to value is going to really reflect how much you have to put down of your own money. Loan to value on these, you're not getting low down payments. These are for investors. These are for investment properties, vacation rental homes, that sort of thing. So loan to value we're talking about here is generally going to be like, you're going to need to put down 20 to 25% on average. I've seen a few DSCR lenders go with 15% down, but generally 20-25% down is the starting point on these. As you would imagine, the interest rates on these are going to be about 1.5 to 2.5 points higher than a conforming or a government-backed loan. So you're not going to get bottom-of-the-barrel rates on these for the market, but you are going to get a competitive rate. It's really looking at a return on investment. If you're taking out one of these loans, it's all about profit. It's all about returning your investment. So you need to look at if the mortgage rate is going to be, let's say, 8 or 9%, is your return on that investment going to be higher than the mortgage rate? If your return is going to be projected higher, then it may be a good financial move to move forward. If your projected return is not going to reimburse you for the cost of the mortgage, then it may not be a good deal and you need to move on and look for other options. Now, as far as the guidelines, one of the things about DSCR loans is that there's no general guideline. It's not like a conforming loan where it's controlled by Fannie Mae, Freddie Mac, FHA, VA, or anything like that. So each investor, each lender is going to have their own guidelines. That's why some will require 25% down, where another may only require 20% down. And that's, just going to be the same with everything. Like looking at different options, talking to different lenders, which we'll talk about in a second, is going to be one of the keys to getting the best DSCR loan for your needs. You're also going to find reserves as a requirement on pretty much all these loans. So what reserves are is they're going to take your principal, interest, tax, insurance, and HOA payment, if it's applicable, multiply that by generally either 6 months or 12 months. That's the amount that you need to have liquid available, generally speaking, to qualify for these loans. Since they're not verifying your income and they're using the income of the property only, they want to know that you've got some financial backing with reserves. That could be a stock account, investment account, 401k, cash value life insurance, savings, CDs, anything like that can generally be used for the reserves. So check with your lender on that. But the last thing I want to talk about is who do you use for these? Because your normal lenders that maybe you'd go to as a first-time home buyer or as somebody looking to get a conventional loan, it's going to be different than somebody who's going to get a DSCR loan. So I only started getting fluent in these in the last 12 to 18 months. You really want to make sure you're dealing with a lender that's been dealing with these at least 6 months or more and has a couple closings under their belt. The reason why it's important is because these are a different animal. So different things come up on these that don't come up on other loans. You need to have someone that understands and knows how to navigate this process and how to get you through the underwriting process, because it can be a lot crazier, a lot more stressful and more tumultuous than a regular loan, because again, these guidelines can change, things are constantly evolving, guidelines are being added and removed. So having a mortgage lender that's really fluent in this and has the experience to back it up is important. So just make sure when you're doing your research on Google, Facebook, Yelp, when you have that interview with your lender, make sure that they know that you're looking for a DSCR loan. Make sure that they know that you're looking for someone with experience so that they can tell you what their experience has been, what lenders they work with, that sort of thing. You're also going to want to make sure that you're dealing with someone that maybe has multiple lenders on this. Like I've got at least 5 lenders that I deal with. We underwrite these loans in-house, and we also have other lenders we broker them out to all over the country. So if it doesn't work with one lender, we can shop it with another one. Talk to an account executive there, tell them the hurdle we're up against, and they might be able to come up with a better solution. So that's really how you want to figure out who to use. This is not going to be a loan where you can really shop around for the best rate, because if you're getting one of these DSCR loans, there's a reason for it. So expect, like I said earlier, to pay higher than the market rate whenever you're getting these loans, even if you have excellent credit. Now, I am happy to assist you. I do offer DSCR loans. So I can do a personal one-on-one consultation with you, give you a customized solution, and you can reach out to me by call, text, or private message. 860-413-3938. If it's your first time here on the channel, hit that subscribe button, smash the bell, and share this with somebody else. Maybe you know of someone who's looking to expand their real estate portfolio, buy more properties, or get into the game with that. Share this with them. They're probably looking for great information to get more clarity on the process and different loan options that may be available. As I said, if I can be of assistance, reach out. As always, I hope this helps, and we'll see you on the next episode. Take care.